Hi, everyone. Good morning. I am Martha Stokes. I'm a chartered market technician, and I'm trying to give you information that is going to help you make more money in the market using Tradingview charting software. We have today a discussion about sell side institutions. We've been talking mostly about dark pools, buy side institutions, professional traders who work for the buy side. Today, we're going to talk about the sell side. The sell side has a uniquely different price action pattern than the buy side. The buy side likes to keep everything tight, penny spreads, TWAP orders, this type of thing. The sell side has a variety of responsibilities in the market. These are the major big banks in the US and other huge banks globally, as well as financial services gigantic such as Goldman Sachs. So these companies are totally different and their trading is totally different. They have floor traders, and the floor traders that they have hired and have working for them are the best of the best in the world. So they seldom make any serious mistakes. They are very savvy traders. And when you trade with the sell side institution floor traders, you're going to make more money than if you trade against them, which you will lose money because they have more clout and more money to trade than you do. They are short-term traders. They are swing traders. They are intraday traders. They're very active in the market, and you can see their activity on CVX. They favor oil and gas companies often, and they have other industries that they also like as well, and they will trade these up and down and have all kinds of activity that is going on. They are also market makers, and they have been supporting the Dow recently because it has been going down and they're trying to support certain stocks in there. So they are buying to cover. They'll sell short and then they'll buy to cover and make profit on their selling down. So this is a good example of the sell side institutions selling down a stock and then it reversing. And then they can drive the price upward. Now, the difference between buy side and sell side is the sell side can have long, big runs, longer big runs down because they're selling short. They're the market makers. So when this stock starts to turn down, they are making the market by selling short and then buying to cover. They make a lot of money doing so. And a lot of times they can cause a void, can cause them to have even more money because what's happening is a void of buyers can occur. And we can see that the void of buyers is occurring because the dark pools have ceased buying the stock right about in here. They stop buying that stock. That's as high as the prices they're going to go on that. So then it collides down to the low. And this is a signal to you with these indicators. This is shaken. And you can see that this oscillator is telling you that that's the end of the downtrend. So on that day, when that hits down, it's time to get out and plan for a reversal and moving back up. The big banks control price in a wider range than the buy side institutions because they are trying to push price up or push price down because they make money. When it takes off and it runs like this, they'll let it run and run. And then you see the peak here, which would tell you, okay, the big banks have stopped buying the stock and they're going to start selling it short. So they do both all the time in stocks. And that's why we have these wide trading ranges that you see in certain industries and certain companies and certain stocks. They are a major part of the market. They're not as major as they once were. The buy side dominates more and has far more assets under management. This is a short-term trading situation. The big banks always were short-term. They were market makers for years and years, and they continue in that category of market participant group. They're important to understand what signals they have. This happens to be a buy-side institution signal to move up and buy some shares. They're usually very tight, but you can get some really big and nice runs out of the sell-side institutions if you understand and if you can use some floating oscillators and flow of money stream and so on and so forth. There, money flow is very important because the money flowing in tells you how long this run will last. So you want to use oscillators that give you volume oscillation as well as money flowing in or out of a stock, because when money is flowing out of a stock, what you have is a void of buyers and the price will collapse rapidly and you can make very high income on selling short with the big banks, the sell side institutions. That is my topic for the day. Have a good day trading, trade wisely, and I'll see you next week.